How to get unsecured cash flow loans with fast approval for your business. Call 888-653-0124 today or click the link in the description to learn more. Are you struggling to find cash flow loans for your small business? Or maybe you need fast approval for a business loan. Well, you're not alone. Many people are looking for quick cash flow loans for their businesses. When you need quick access to funds, you may not have time to wait around for approval. That's why getting unsecured cash flow loans is important. These types of loans help you pay bills and cover expenses until you receive payment from customers. They don't require collateral, which means they're easier to obtain than secured loans. Understanding cash flow loans. The best way to understand this type of loan is to think of it like a payday loan. It's a short-term solution to a financial problem. If you don't pay back the loan, the lender will take possession of your property, like your car, and sell it at auction. This means that if you default on the loan, you could lose everything. Business cash flow loans offer similar benefits as payday loans. They allow you to get money quickly when you need it most. However, these loans can be more expensive than traditional bank loans because they carry higher interest rates. Cash flow lenders usually charge between 10% and 15%. Compare this to the 2 to 5% APR charged by banks and credit unions. You should carefully consider whether you want to use a cash flow loan before applying. If you do decide to apply, make sure you read all terms and conditions thoroughly before signing anything. You can also ask questions during the application process to ensure you fully understand what you're agreeing to. When can I use cash flow loans? The interest rate on unsecured cash flows loans varies from lender to lender. Typically, they range between 10% and 25%. This means that if you borrow $1,000 at 20%, you will pay back $200 per month plus the principal amount. If you borrow $1,500 at 15%, you will pay back only $150 per month plus the principal. Getting a business cash flow loan isn't difficult. The main thing to remember is to shop around for the lowest possible interest rate. Most lenders will accept applications over the phone or via email. Some even offer live chat options. To apply, simply fill out an online form and submit any supporting documentation requested. Within 24 hours, you will receive an answer showing whether you were approved. Unsecured business financing is a great option for many reasons. Having the access to bridge financing can keep your company afloat while you look for other funding sources. It's also helpful in times of economic uncertainty. When there are fewer jobs available, companies often face difficulty finding qualified applicants. By providing them with additional capital, you can give your employees the opportunity to stay with the company longer. Asset-based lending. Leveraged loans are another common source of financing for small businesses. Asset-based lending is different than traditional bank loans because instead of borrowing against assets like real estate or inventory, you borrow against the value of your business itself. This allows you to borrow up to 100% of the value of your company. Because asset-based lending is so popular among entrepreneurs, it has become increasingly difficult to find lenders willing to lend to smaller firms. Some entrepreneurs turn to these accurate loan offers. These types of loans are attractive because they are less risky than traditional bank loans. Unlike a bank loan, which requires you to put collateral down, leveraged loans require no security. Instead, asset-specific loans rely solely upon the value of your company to secure the loan. When choosing an asset-based lender, it's important to choose one that specializes in making loans to business owners of all sizes. Business loan options and underwriting. There are many unsecured business loans available. Some are better suited for startups than others. The best way to find out which type of loan will work best for you is to speak with a lender. Access to financing doesn't always depend on how much money you have. Many companies don't qualify for traditional bank loans because of their size. That's why many entrepreneurs turn to alternative sources of financing. One of the most popular alternatives is commercial credit cards. These cards allow business owners to take advantage of investment decisions, low rates and flexible payment plans. Another popular alternative is factoring. Factoring is like a line of credit, except that it usually comes with a set term. Once you agree to pay back the amount owed at the end of the term, the balance becomes part of your receivables. This gives you more time to pay off the debt without having to worry about missing payments. Factoring is often preferred when dealing with short-term needs. The underwriting process for asset-backed securities is complex and can be costly. In addition, it takes a long time to close a deal. For this reason, many small business owners prefer factoring over traditional bank financing. The last option is merchant cash advances. This type of financing allows businesses to use their own accounts as collateral. It is often used for short-term needs. With any kind of financing, it's critical to understand what you're getting yourself into. What are the downsides to cash flow loans? The biggest downside to this type of loan is that it requires applicants to pay back the loan before they receive any money. This means that borrowers must increase their cash flow so they can repay the loan. If they don't, then they will lose all the money they borrowed. Another potential problem is that some lenders charge high interest rates. Having assets at risk is also a concern. Lenders want to make sure that they will get their money back if the borrower defaults on the loan. There are other risks associated with this type of financing as well. For example, there is no guarantee that the business owner will continue to operate after receiving the loan. If the business fails while still repaying the loan, then the lender might lose its entire investment. The recovery risk depends largely on the financial health of the company and its ability to generate enough revenue to cover the loan. Finally, there is the possibility that the business owner may default on his or her obligations. This happens when the borrower stops paying back the loan or misses a few installments. When this occurs, the lender may seize the assets pledged as security. Consistent annual revenue streams. Having strong annual revenue streams is another important consideration. Borrowers should try to keep up with their monthly expenses in order to avoid falling behind on payments. If a business isn't generating enough revenue to cover its bills, then it won't be able to afford to repay the loan. This is one reason it's important to establish a budgeting system early on. Annual cash revenue requirements should be included in the budget. As mentioned earlier, factoring and merchant cash advances require applicants to put up collateral as inventory or equipment. This makes them attractive options for those looking to borrow money quickly. However, it also increases the risk of losing everything if the borrower doesn't meet his or her repayment obligations. In contrast, unsecured cash flow loans allow borrowers to access funds immediately. This makes them ideal for small businesses and freelancers who need quick access to capital.